Good afternoon. We welcome you all to this live webinar on red flags in relation to avoidance transactions review under IBC, organized by Committee on Insolvency and Bankruptcy Code of ICAI. I would request our chairman of the committee, CA Anil Bhandari ji, to please start with the session today with his address. Over to you, sir.
Thank you, Rita, and a very good afternoon to all our members. I'm happy that we have Dr. Navrang Saini ji today with us, who is the whole-time member of the IBPI. I'm also really glad that my ex-colleague in the Central Council, we have Shripriya with us to help us to go through this session that we have. The live webinar today is on red flags in relation to avoidance transactions review under IBC. I think this is going to be a pretty interesting topic for all of us as we see the IBC evolving over a period of the last 2 or 3 years. Thank you once again to our esteemed guest and our speaker today. The committee, IBC, I think, we've been taking some interesting initiatives around the case studies, which I think has gone well with our membership. Every month, I think we run a case study program, starting especially from the SR Steel that we did, and getting deeper into the insights, which is so important to run organizations of these size and take it to the resolution. Really happy that as the entire country, I think in the last 2 or 3 years, this has been a transformational law that, we have all come through. I believe that we have had more than 200 cases that have gone through the resolution process, more than 200,000 lakhs gone through, crores gone through in terms of the amount that has been settled. I think the exciting stuff which is likely to come forward is the pre-packs, which I think we are looking forward, and there hopefully should be a lot of discussions around this, because this will help us to resolve the time elements specifically for the during the insolvency process. And also the cross-border insolvency is another area which I think I especially look forward to engage with all our members. So I do hope that, we would have something interesting coming up, and we would keep the members informed and keep them engaged. Besides the case studies and the pre-packs and the cross-border that we are hoping to have, we are also forming an expert group, and we would, of course, invite some good experts around the country to help us to maybe prepare for what is likely to come around this new areas. With me, we also have our Vice Chairman, Pramod Bhupji. He's been absolutely a great help for all the programs and all the webinars and all the case studies and publications that we continue to do under the committee. And I'm really happy that I've got an excellent colleague with me in the council to help us in the IBC committee. So I would like to keep this very, very short, because I think we've got absolutely a great session today. First, our keynote session with Navrangji today. I think, Dr. Saab, thank you so much once again. I would like to just quickly introduce Dr. Navrang Saini ji, who would help us to the keynote session and the guidance. So, Dr. Navrang Saini ji,
we can start the session.
I'll just take only 1 minute, sir, because I think our members would be, I'm sure, would be happy to hear the whole-time member who is here. So Sani ji is, of course, the whole-time member of Insolvency and Bankruptcy Board of India. He has served the Ministry of Corporate Affairs in various capacities. I'm truly excited that he has been part of the commissioned officer in the Territorial Army from July 1985 to March 2001, and has superannuated as Lieutenant Colonel. That's really, really very interesting. He's also been the Registrar of Companies in Delhi, Haryana, where he implemented the first mission mode e-governance project for the country, MCA 21, as a major pilot project. And Dr. Saini ji was a member of the affiliate authority established by the central government in accordance with the power, of course, in the Chartered Accountants Act, as well as the Cost and Works Accountants Act and the Company Secretaries Act from the 3rd November 2015 to the 2nd November 2018. And he's presently looking after registration and monitoring wing, comprising insolvency professionals, insolvency professional entities, as well as information utilities and insolvency professional agencies, and so on and so forth. So I think just to put this in one line, I think we have, and thank you, sir, for coming over on this session. We are looking forward to you help us to guide our membership base, especially around what the IBBI has been doing, and also especially around the topic that we have today and how you foresee that coming up.
Thank you very much, Anilji. Anilji, Pramodji, Madam Sripriya, Madam Rita, and participants. Very good afternoon to all of you. I would like to thank the committee for organizing this webinar for the benefit of the participants. This not only actually gives an insight of the subject to the participants, but the regulator also gets so many new things which are to be done in future. So to start with the topic today, the webcast is on red flags in relation to avoidance transactions review under IBC. I'll be briefly touching avoidance transactions. As Madam Sripriya Kumar is there, she has done, as I actually in my initially also I informed that she has done a lot of work on the red flags, and she will be actually dealing with the red flags. So in the CIRP process, an IP may be an IRP or RP. In liquidation, he becomes a liquidator. The same IP may continue in all the three processes or may be different in all the three processes, because there is provision for the replacement of the IRP also, and there may be a different liquidator also in the liquidation process. Of course, the objective of the code is the resolution and not the liquidation, but in many cases, the stressed CD may go into liquidation. Therefore, all the provisions of the code are to be complied. The IBC 2016 or 2016 casts several responsibilities on an insolvency professional. We all know that powers are always with the duties. The need for avoidance proceedings can arise in both CIRP and liquidation proceedings. The code read with regulations has demarcated the responsibilities of an insolvency professional in CIRP and liquidation process to enable an IP and the committee of creditors to have a complete and clear understanding of their roles and responsibilities in a CIRP. The IBBI on 1st March 2019 issued an indicative charter of their responsibilities prepared in consultation with the three insolvency professional agencies. Since the COC does not exist in liquidation process, the liquidator has independent and exclusive duties. The emerging jurisprudence is bringing further clarity about their roles in corporate insolvency proceedings. During the course of time, it has been observed that IPs seems to be following different practices for identification of avoidance transactions and filing applications before the AA. So just to answer the queries of Anilji that what the board is doing, I can only say that yes, the board has been discussing these with the insolvency professionals, and yes, we are preparing a document, and maybe guidance, maybe IPA may be issuing some guidance for the insolvency professionals. Now, if we talk about role of IPs in avoidance proceedings, Section 25 and Section 35 of the code enumerates the duties of resolution professional and liquidators respectively. These duties include certain actions in respect of avoidance transactions. During the process of CIRP or liquidation, as the case may be, if a RP or liquidator comes across of any avoidance transactions under Section 43, 45, 49, 50 and 66 of the code, he should file applications with the adjudicating authority seeking appropriate reliefs and directions permissible under the code. Section 47 of the code provides that the AA shall require the IBBI to initiate a disciplinary action against the RP or the liquidator, as the case may be, where he has not reported undervalued transaction to the AA. Additionally, Section 59, subsection 6 incorporates reference to Section 43, Section 45, Section 49, and Section 50 in context of voluntary liquidations as well. So the IP has to take care not only in CIRP and liquidation, but voluntary liquidation also. So IBPI, just to facilitate the IPs, IBPI has prescribed timelines in CIRP regulations. If we see regulation 35 of the CIRP regulations, it requires the RP to form an opinion whether the CD has been subjected to any avoidance transaction on or before the 75th day of insolvency commencement date. And if he is of the opinion that the CD has been subjected to any transactions covered under the above sections or aforesaid sections, he shall make a determination on or before 115th day of the ICD under intimation to the board. The same is also required to be confirmed in form as annexed to the CIRP regulations. He is also required to apply to the AA for appropriate relief on or before the 135th day of the ICD. These provisions aim to claw back the value lost through avoidance transactions in sync with objective of maximization of the value of the assets of the CD, which is actually enumerated in the objects of the code. Under the code, the transactions which can be identified are preferential transactions under section 43, undervalued transactions under section 45, transactions defrauding creditors under section 49, extortionate credit transactions under section 50, fraudulent trading under section 66(1), and wrongful trading under section 66. It is worth to note that each of the transactions is distinct in their nature. There may be several questions which may come to the mind of IPs, and there may be a question whether every RP in every CIRP examine and investigate if the CD has been subjected to any avoidance transactions. So I am taking only two questions. Remaining I'll leave on Madam Sripriya Kumar. She will take all the questions during the process. So that to answer the first question, section 25 subsection 2 clause J, which stipulates that it is the duty of the resolution professional to file for avoidance of transactions if any. One should note that the RP has to confirm in Form H of the CIRP regulations as to whether the RP has made a determination if the CD has been subjected to any transaction of the nature covered under section 43, 45, 50 or section 66. Section 35, subsection 1, I enjoins upon the liquidator to investigate the affairs of the corporate debtor to determine avoidable transactions. Section 47, subsection 2 empowers the AA to require the board to initiate disciplinary proceedings under a RP against a RP or liquidator. If the said RP or liquidator, even after having sufficient information or opportunity to avail information of such transactions, did not report such transactions to the AA. So therefore, now it is the duty to report if any such transactions exist, and it is expected from the RP in every CIRP and the liquidation process to examine and investigate if the CD has been subjected to any avoidance transactions. Another question which may come to the mind of the participant, that who can help an IP in detection of avoidance transactions? In my view, the answer is that an IP may take assistance from a professional having experience in related domain and regulated by the professional body as per discussions above or whatever I have stated above. Approval of COC shall be taken by the RP regarding the fees of the professional. The RP may get the budget approved in the first COC or can get the approval on each matter depending upon the case and the pertinent situations. It should be clear to the IPs that they can appoint the professionals as an IRP also and RP also. They need not to take the permission of the CIRP for the appointment. Only required is that approval of the cost. So they are not required to actually go to COC whether they should appoint any professional or not. Of course, cost is to be approved by the COC. It has been observed that in some cases, COC does not approve the proposal for transaction audit or the fees, the resolution professional. So in such cases, the IP should record all the deliberation in the minutes. So in future, if somebody asks that why he has not reported, so the thing should be clear. While concluding, I would like to say that there are several process challenges during the CIRP or the liquidation that may be COC related challenges, availability of the reports, delay in decision on application filed with the AA. But an RP or the liquidator has to deal with every case depending upon the circumstances. So with these words, I conclude, and I thank you to the committee for inviting me here. Now over to the chairperson of the committee and of course, Madam Sri Priya Kumar to lead the discussion. Thank you very much.
Thank you,
I
sir.
may kindly be permitted to leave. Thank you very much.
Thank you, Saini sir. Thank you so much. Really appreciate your good words and your guidance to all of us, sir, as well. Thank you, and we would keep engaging with you, sir. Thank you so much.
Thank you very much.
I think with this, if you could just give us a minute, I would actually ask Pramodji to maybe do the formal vote of thanks, sir.
Sir, that is not required. We are all part of. This country, and we have to actually do our duty. So we should not only ask the RPs or IPs or liquidator to do their duty. We should also do our duty.
I always get
our
encouraged
duty to actually educate and whatever we have to share with them. So I'll request Pramodji not to do any such thing.
Sir,
thank you very much.
Sir, it will take just 30 seconds, sir.
I always get encouraged. When I hear Pramodji actually give a vote of thanks. So may I request Pramodji to please take it forward.
Thank you, Anilji. Let me take this opportunity to thank the learned and knowledgeable Dr. Navrang Saini ji for such a lucid and illuminating address. I'll surely say that we all professionals had a good learning time and we all are more enriched and enlightened after hearing your excellent deliberation. Many thanks for taking us through this journey of insights. Thank you so much, sir.
Thank you, sir.
Thank you very much. Thank you.
Thank you, sir. So, Pramodji, I think
yes,
I would now request you in this, sometimes I keep thinking, Pramodji, this is a very tricky profession, managing companies, preserving value, avoidance of transactions. I think all that we used to do as chartered accountants has suddenly been put in a big box and now has been, provided to us as managing it as IP. So please do take this session forward, Pramodji, and we would love to then hear Shri Priya ji. Thank you.
Sure, sir. Well, friends, I'll begin with respected, esteemed professional colleagues, Shri Priya ji, Anil ji. Good evening to all. As we all know, we at ICI have come up with several enabling measures and initiatives to promote knowledge as ultimate weapon in these challenging and dystopian times. We are providing best learning experience through webinars for the benefit of all our professionals. And today's webinar on red flags in relation to avoidance transaction review under IBC is again very important from the perspective of insolvency professional, as the code requires the insolvency professional to file application to the educating authority for avoidance of transaction, if any. So before I hand over the proceedings to the learned, knowledgeable speaker, Shri Priya ji, just a brief about her. I'll simply say a senior chartered accountant having vast reservoir of experience and knowledge, a brilliant and noted educationist, or maybe professional, a person of intellect having astonishing diversities of interests. Her lectures are models of, I can say, clarity, brevity, and wit. And I can say here, her role in making us understand this IBC code validates the traditional Indian belief in the indispensability of the guru and a visible indication of her enormous professional merits. A prolific speaker, a proactive personality, a very down-to-earth personality. Well, Shri Priya ji, before I ask you to begin your deliberation, just a request to cover 2 points also in your deliberations, maybe the duties and responsibilities of the RP with respect to avoidance transactions and the requirement to conduct transaction audit for determination of avoidance transactions. If you can include these 2 topics also. Over to you, Shri Priya ji.
So, at the outset, here's a very, very hearty thank you for inviting me to this session. And I must honestly admit that I have never been so eloquently introduced by anybody in the past.
I was about to tell you that even I didn't know so much about you, Shri Priya. So, I not mention, I keep getting encouraged when Pramodji speaks here.
Yeah. So the thing is, I mean, more than what he said, I think today what takes over is how he said it. And this is the first time I'm hearing Pramodji speak, so it speaks volumes on why he's actually in the Central Council. So very nice, and thank you very very much, sir. So coming to the topic of today is we're going to talk about avoidance transactions, and should either of you need to be excused because you might have other commitments in terms of a committee meeting, please go right
No,
ahead.
so Shripriya, we not that we would have other engagements, but we would actually like the speaker to take over the session and run it. I would join back at around 4:30, and we will do a question and answer. Pramodji, I think, has got a disciplinary meeting, so I think, but I would join back at around 4:30. Yep.
Sure. Thanks,
Please continue.
Pramodji.
Thank you. Thank you.
So we're going to talk about avoidance transactions today with specific reference to an IBBI document which is rather new, which has been released. And that's the facilitation notes to guide an RP on when you need to do an avoidance review. So I have my presentation structured in two parts. One is I have something like a 40-slide presentation that I'll run you through very quickly. And I'll leave this behind for us to, sort of assimilate on a self-learning mode. And then I'll briefly introduce you to the document itself, which is the IBBI red flags document. For about 20 minutes, we could quickly go through it. And so it's 3:25 now, and I hope to wrap this up by 4:30, and then we can still have a half an hour of questions and answers. So, and once again, I'm very, very privileged and honored to be here. I'm going to share my screen. I have pretty good bandwidth generally, but if I do find that I have a slack, then I would go off video and continue with my screen sharing alone. So, and once again, and here's a very hearty welcome to all the participants as well. I don't know, I'm not able to see anybody, but I guess we're all there. So, over to the topic. So, is my screen visible? Rita?
Yes, ma'am, it is.
Sure.
Yes, it is. Yes, it is, Shripriya. Please go ahead. Yeah.
So, and this is an opening slide that I always like to put in all my presentations on the IBC because it sort of reiterates what this code is all about. And these are the opening lines from the executive summary of the BLRC report, which state that the limited liability company is a contract between equity and debt. As long as debt obligations are met, equity owners have complete control and creditors have no say in how the business is run. When default occurs, control is supposed to transfer to the creditors and equity owners have no say. Ladies and gentlemen, and this is the new ethos of debt resolution in the country if IBC is invoked. And that's moving from debtor in possession to creditor in control. And that's creditor in control during the CIRP process entirely and a liquidator in control during the liquidation process. Now, obviously, here we're sort of moving to a revised system of creditor in control. It obviously is conflict-ridden because what motivation do I have as a creditor, as a banker, to enable resolution when I've offered 5 to 6 one-time settlements and it's not run through? So it's a very conflicted role. So the law also thought it's very important for this entire process to be managed by an independent stream of professionals. And as a consequence thereof was born the insolvency profession in India, the profession of resolution professionals and liquidators who grouped as insolvency professionals. Of course, on the other aspects, I'm really not going into it. The code doesn't define insolvency, but we all know that this is a default-driven legislation. So you really don't have to wait for an account to become non-performing or discover after 2 years that somebody is not paying you. You can trigger an NCLT process under the sections 7, 9, and 10 as soon as there is indication and evidence of a default. So from there on, what we speak about today will be on the subject of avoidance transactions, RP responsibility, which I added now, and why is such avoidance transaction determination necessary at all? IBBI, and of course, we'll run you through the IBBI facilitation note, which is to aid RPs in the matter of avoidance transactions. In terms of the note itself, I think it presents a very compelling case. See, again, today in the Swiss Ribbons judgment, it says RP is an administrator. It's the COC that's paramount and they run the process virtually. I mean, they administer, they control the process. They control the corporate debtor. So in a lot of circumstances, as Dr. Saini also mentioned, there is always the COC might say, why do I have to do this review? Can you prove it to me? Do you really need to do this? What's happened? And in certain cases, the COCs themselves are slightly conflicted because they have also performed certain forensic reviews in the past. So if at all this facilitation note aids, sort of attempts to strengthen the hands of the RP. And this, I think, it's also very important. It's paramount that if, as a statutory auditor, your independence is X. There is really no quantification to independence. It's kind of pretty much the underpinning of our profession. But I just want to say, if as a statutory auditor, your independence is X, as an RP, it should be 3X, 4X. You can't afford to have a situation in any of our processes where you actually run with the hares and hunt with the hounds. You can't take two sides on all matters. You have to stay balanced and you have to stick to, the code and what you're doing. And in that, while certain other aspects of the code have been fairly well enshrined. So, for example, you have a section 28. It clearly tells you, okay, this is what you need to go to the COC for approval, and these are your exclusions. It clearly tells you when you have to issue your EOI, X number of days. It says you have to do a registered valuation with 2 independent valuers. Now, when it came to the subject of preferential transactions, one would actually feel that it's a bit hazy. It's a bit hazy also because of the qualitative attribute involved. So what this facilitation note seeks to do is to try and convert those qualitative parameters into some objective yardsticks for the RP to initiate an avoidance review, and more importantly, ensure that your COC buys into such review. So as a COC, if I go with very comprehensive and clear data on why I believe my preliminary determination is good, then your COC will not have an option but not to do this. And it just helps you to put out those notes in a far more clear manner. So what's the objective of the avoidance process? Now you forget everything else. I think there are just 2 things that are relevant and noteworthy. This insolvency process is all about bringing money back in. Bringing money back in to run the company either as a resolution or bring in money to liquidate after liquidating the assets to pay off the creditors. So in either of these circumstances, you have certain sources of funds. You have existing and future assets. Existing asset, I have debtors whom I'm going to realize in cash. I have non-core assets which I want to sell. Now, what is very relevant is, that's the first part, which is existing assets. Similarly, I could have some litigation by which the corporate debtor can get money. That's your future asset. Any pending recoveries. The second is a resolution plan that somebody seeks to bring and says, okay, I'm going to pump in so much funds into the company. I'm going to take over the shares of this company. I'm going to run it. Great. So that's the second source of funds for tiding over an insolvency. But the third and the most critical element, which I would also think is relevant, is your avoidance clawbacks. Where a corporate debtor has been subject to certain avoidance transactions, it's incumbent on the insolvency professional, whether an RP or as a liquidator, to bring that money back into the company. Now, in the case of liquidation, there are only 2 sources of funds. You obviously have exhausted the possibility of a resolution plan, which is why you're coming here. So you either have an existing asset or you have a scheme of compromise. Somebody, proposes a section 230, or, there's liquidation as a going concern, which is becoming very famous in terms of, its latest advent. And of course, the existing assets. Now, keep this aside in one bucket, whatever I told you, and move on to the next bucket. Now, the BLRC report, which was actually the precursor to the law itself, spoke about 3 reasons why organizations fail. Organizations fail because of financial failure. So you have an interest before earnings and profit before earnings and tax, profit before interest and tax. But after interest, there is no profit. So it's very leveraged. So you have a financial failure. The second thing is a business failure. I started a hotel, let's say just before the lockdown, and it just crashed. I started a software company, it didn't take off. So that's a business failure. But there's also a third reason why organizations fail, which could be because of promoter malfeasance. Promoter malfeasance. So the objective of avoidance is also to identify such cases of malfeasance which needs to be disgorged, clawed back, and brought back into the company. And that's my second bucket. Now, In terms of, let me also describe the third bucket in this. So we've spoken about malfeasance being an important source. We've spoken about sources of funds. Now there's another very interesting thing. Your avoidance transactions come in the categories of 43 preference, 45 undervalued, 49 transactions defrauding creditors undervalued, 50 extortionate, and 66. There has actually been not much jurisprudence which has come out very concretely on the matter, except for one major Supreme Court judgment in the case of JP Infratech. Having said that, there's a very clear view that says all preference transactions need not necessarily be fraudulent. A preference is a plain reading of the code. There does not have to be a mens rea, an intent to fraud. So if I've preferred one creditor over the other and not in a normal course of business, that's very clean a preference. And similarly, all fraudulent transactions in 66 do not have to be preference or undervalued. I could have a case of fraudulent book stock reporting. That's a plain 66. It does not have a preference or a undervaluation attached to it. In all, the corporate debtor has actually attempted to get a larger working capital limit where he should not have been entitled to it. Consequent to which, the disgorgement also becomes slightly complicated. So if somebody comes and says this is fraudulent book stock reporting, or there are in fact enterprises which have just pumped up their sales, obviously there is a GST or a service tax or a VAT failure, but somebody's pumped up their sales, pumped up their purchases, pushed up, shown fictitious receipts, fictitious payments, and somebody's just bloated up the scale of the balance sheet just to be eligible for, let's say, certain government tenders. In such a case, what will you disgorge? Now, that's a separate aspect by itself, and that's for the courts to determine. But then there is a certain personal liability which starts ticking in under various laws on the directors themselves. So, but I'm just putting that thought into you. So you must really not think of disgorgement. If you think there is a transaction which is 43, 45, 49, 50 or 66, and I'm really not going into what this transaction here is, because I'm sure most of the people who are attending this are either forensic auditors or resolution professionals who would be very, adept at understanding these sections. Now, for any serious practitioner of insolvency in the country, I think it's extremely important that you know the code and the regulations, obviously. The emerging jurisprudence, again, obviously, and just a few moments back, I was telling Anil a few minutes back, actually, that we must start from the institute side an initiative to speak about the new developments, both on the cases and the changes to the code to help us. The other important thing is obviously the BLRC report, which was submitted in two parts. One was the circumstances that led to the advent of the code, and the other is the code itself, a model law. One does not have to read the model law part of the BLRC report because you have a real law in place. But the first part is very, very relevant because it helps to set the context of the work that you're doing. And and most importantly, I also think you should read the UNCITRAL legislative guide on insolvency. This is a guide that is published by an United Nations body which puts out a legislative guide. It basically talks about every single aspect of insolvency resolution, sets out certain principles, which is just a guide. And normally any territorial jurisdiction which either wants to implement a new insolvency law like India did, or wants to improve its existing law, would go to the legislative guide and pull out. Okay, the legislative guide will say you must have a designated adjudicating authority. In our case, it's called the NCLT and Supreme Court. The legislative guide would say you need to have relevant time, a look back period defined. So in India, the look back period is called as the relevant period for avoidance transactions. You have 2 years for related parties, 1 year for unrelated party, etc. It's got over 150 such regulations which we adopt in the code, and it's generic, it's agnostic. In India, we followed the themes, which is actually creditor and control, but there are other jurisdictions in the world which go with the Potomac, which is the US, which is actually debtor in possession. Now, what is, I think the best description of avoidance transactions, it's a fairly long set of paragraphs, but I thought you should only, take the first three, which I thought were very good. And in that, I'd just like to focus on A. The whole objective of an avoidance transaction review is to reconstitute the integrity of the estate and ensure equitable treatment of creditors. That sort of summarizes for you what this entire gamut of avoidance transactions reviews are all about. You have to bring back to the estate what has been wrongly lost, wrongly and fraudulently lost. In fact, I wouldn't, insist too much on the wrong part, because you can have an innocent preferential transaction and it's still a preference. So that's about it. So, and interestingly, the entire chapter on avoidance, the part on avoidance sits in the chapter, in the part on liquidation. The whole thing is enshrined. Section after 32, you move into liquidation, right? Where are your avoidance transactions placed? They are placed in sections 43 to 50. But while it comes in the aspect of liquidation, it's been pulled ahead by casting an obligation on the RP in the CIRP process to carry out this examination. And as Dr. Saini said, they've defined these timelines. You have to identify within so many days, you have to file your applications to adjudicating authorities within so many days, etc., etc. But there are two key principles in avoidance transactions. One is your 53 waterfall should be disrupted because of that transaction. Two, that transaction should not be in the ordinary course of business. These two are extremely important, but for 66, it's a much larger gamut on which I think transactions. So my essential 43, 45, 50, etc., I have to look at the 2 years and the 1 year look back. The responsibility is that of the resolution professional or the liquidator. The process and the proceedings. While the proceedings are, described by saying that you have to file an application before the adjudicating authority, we don't really have a process document on how to do it, which is where I think this facilitation note serves the first part. When do I do an avoidance review? What are the red flags that I need to do? I'm sure there'll be more guidance which will come on how to do it, and the how part is something I would also cover in my presentation. And how do you disgorge value and restitution for the rightful recipients? So, and these are the building blocks: relevant time, related and unrelated parties. Now, what's very interesting is your related parties are defined under section 5, subsection 24 and 5, subsection 24A of the code for, individuals. Now, what's really important is to look beyond the defined attributes of these sections. Suppose I have a corporate debtor who's got 50 group companies, none of whom share common directors, but they're all registered in the same address and they have the same mail ID which has been submitted to MCA. Then it acquires this quality of a connected party as well. If you recollect our Companies Act, we have under whose directions the board is accustomed to act. So most of these connected entities would operate on the instructions and be managed by a central entity, which is your corporate debtor or somebody else. And appreciating these intercompany relationships or interparty relationships is crucial to this avoidance. So you just don't only apply 524, 2% share capital, 2 directors in common, etc. It speaks about interchange of managerial and technical information, things like that, which are very relevant. Then you have the third thing which is your transaction types. What are your transaction types? They are again defined in the code 43, 45, 49, 50, 66. And the last one is there is very clearly an intent of the transaction. I think that's something you need to, as an RP, come up with and be as objective as possible. So these are the 4 broad transaction types that I spoke about. So what's the role of the insolvency professional? You need to do a preliminary determination within 75 days of the insolvency commencement date. Conclusion of the avoidance review within 115 days with due intimation to the board. Filing with NCLT within 135 days. Obtain orders from NCLT. Enforce orders. Receive funds. So this is actually the process that you follow. And in this, if this is my y-axis, what's my x-axis? I need to identify why I need to do such a review, which I told you need to bring the value back to the company. The review process. How will I do this review process? Am I going to do this myself or am I going to engage somebody? In my own cases, I found that whenever I filed a 66 application, it was better done with an independent forensic report. So that's something you may want to cognize for. The other important element is notice of the audit. So you can't do this, sitting in a well. This entire process is a court process once you determine and you want to file an application. So there is a certain respect you have to give to the process in terms of notices to promoters to respond. As an RP, I don't think you should share data. You should ask the forensic auditors or your avoidance transaction auditors to interact independently with the management so that data can be obtained directly. At best, you can be copied on these mails because you don't want to take responsibility for this report. And I have seen circumstances where somebody comes to the court with an avoidance application and the promoter comes and says, look, I didn't even know this review had happened. And another thing that I think we should all be mature and objective to understand is there's nothing that it's not like, coming up with this big audit point and you want to keep it hush-hush. I think you should actually upfront this entire report, give them an opportunity to respond point by point. And fair enough, if you're wrong, then you must admit that gracefully and say, fine, it's not an avoidance transaction. I'm not filing an application. And that's something that's a conviction that comes with experience and your own ability to understand and appreciate transactions and be fair. Responses from the auditee. You need to have a conclusive report. And finally, it also flows into whether, the 29A provisions on resolution applicant gets impacted, which is a separate stream by itself. So, another thing is just to give you an example of an avoidance transaction at this stage, just for appreciation. Imagine your corporate debtor got money from a bank, let's say in 2015. They got about 30 crores, out of which 10 crores was given as a loan to a group company. How do I know it's a group company? There are no common directors, but they all were registered in my same address, or the shareholders of that company are registered in the same address as the corporate debtor, or the MCA ID. There are multiple ways. You find that particular company, you ask for details, you get nothing. Then I go to the MCA and download that company, and I find that company has been completely dormant. For the money received as loan from your corporate debtor, the only transaction that company has undertaken is to give a further loan to somebody. Now, this transaction needs to be examined because it's quite possible from there on the funds have moved out and somebody's bought an asset. And in 2015, 10 crores, the value of that asset could be 30 crores today. That value needs to be disgorged and brought back into the company. Now, again, you have two challenges here. You've appointed a forensic auditor. He's gone as far as identifying that money has moved to a dormant entity. Now, if you want him to do one more leg of the action and go and find out where the funds went, etc., then it gets complicated, and that's where you will need your COC buy-in to figure out, what kind of fund availability you have to do all these extra items. But this is good enough for a forensic application because the court will then issue a notice to the other party. Of course, to the other company also you will issue a notice asking them, what did you do with the money that you received from my corporate debtor? So that's how you actually close the loop on a transaction. But these loops seldom get closed completely. But I would think that if there is evidence of movement of funds and funds have not been returned, and that company is a dormant company for which, and my corporate debtor has received no value, it's a good enough case to file an avoidance application. In terms of the process itself, so whether you're an RP or as a forensic auditor, this is the kind of data one would need typically to be able to conclude. One is, of course, the first thing is your tally or your SAP and your day books, which you need to review. Project budget versus actuals, company's budget versus actuals, related party transactions, which are abundantly disclosed, of course, in the corporate balance sheets. You have your accounting standard disclosures, etc. In addition to this, you typically download a trial balance and sort it descending order by value of throughput of debit plus credit, and sit with the corporate debtor and rule out who's this party. Go through party by party for the high value parties and figure out whether they're related or not. creditor agreements, escrow account reviews, current account, your bank statement reviews, financial statements and audit reports. Throw one hell a lot of information, client account statements. These are your core, what you get from the corporate debtor. Incrementally, you do public domain searches, MCA website, download of data, income tax. For example, the IT-80 orders are available. So you Google your corporate debtor's name or that other person's name and, type IT-80, you might get something. GST, other enforcement agencies. So your data sources are primarily internal, external, they're objective, and they're intuitive. So the intuition basically comes with experience. The more you do, the more you sort of start correlating. Because normally a modus operandi is pretty much the same. And as I'd like to share another thing, when you file an application to the court, it must read like a story. So if you've seen these applications, in fact, I was guided by my lawyer who's, I think, outstanding. So in fact, one of my petitions started by saying, the dramatis personae are. So I asked him, why do you write? He says, no, that's how you write applications for these purposes. I'm not saying that dramatic, but it has to trace the history for the NCLT to appreciate. And again, it's respondent-wise applications which are preferred. You don't put 40 transactions and say one application and copy everybody. So you have, let's say, 3 applications or 3 transactions which have been determined with 3 different parties. Please put each party separately in an application. It cannot be a combined application. Because in doing a combined application, you're also exposing a defamation issue. Because somebody might come up and say, why did you disclose about me to the other 2 parties? So you keep these applications independent. However, for one party, you have 10 transactions, which you think are avoidance, then you club them in a single application. And that's what I've been following, and it just makes this adjudication process a lot easier. The engagement approach, this is broadly, again, just a sort of a concluding slide point. So what typically happens? So if it's a very small company, you might decide not to engage a professional at all. You might just want to, do it yourself. You first need to understand and gather data, review financial statements, secretarial records, legal records, bank data and transactions, site visits and inquiries with contractual counterparties, avoidance transactions and exception reporting, and to report the outcome to the NCLT. Now again, here, whether you're a liquidator or whether you're an RP, it's the same. You cannot determine the conclusion of a transaction. All you can do is file it to NCLT and allow the NCLT to adjudicate, and then the appellate process takes over, depending on if somebody is going on appeal. In fact, one part is, I think there have been sort of very large NCLT delays also in these applications, and some of them tend to outsurvive the resolution plan or the liquidation process, something that the board may and the IPAs might, figure out whether we should, NCLTs also should look at the next level of capacity building to help out with these kind of issues that the RPs are facing. Don't know about the others, but I do know of cases where the processes have taken slightly longer, very long actually. Now, with this, I've also presented some case studies, but I'm going to sort of walk you through just in terms of setting the context. 1 minute, let me just see the time. Yeah, 3:50. So I have another half an hour. So what I'd like to sort of expose you to now is very common avoidance scenarios and how they flow in from the financial statement components. Once we do this, we can go to that note and we can quickly go over. These are more transactions. These are illustrations of avoidance transactions. In share capital, you could have share capital not at all received by the company. It's just been used as a leverage to obtain bank funds fraudulently. I receive share capital from somebody, but immediately I transfer it back as a loan to the same company, which means the spirit of the share capital has not been met. Exorbitant share premiums from investors. Again, not through bank sources and diverted later. The very same share capital has been brought in through a maze of investors to whom funds are provided by the CD. The CD gives, so what is very important is if you have a large capital infusion, look for transactions, a couple of months before that large fund infusion and after that fund infusion. So it's not merely enough if a share capital was brought in. The crux of the issue and what's to be very intricately examined is whether the share capital was indeed deployed for the entity. Shareholding is fictitious. Somebody is shown as a shareholder, the money has flown away. I go and some other company has invested shares in my company. I go to that company. It's not even shown as an investment in their books. Company funds being used to purchase shares of the company by directors. My share capital has moved from, let's say, one shareholder to another shareholder, one director to another director, and the company is paying for such director transactions. These are some common illustrations that you might want to look for. Secured loan, loans recorded by mere book entries. There's nothing. No money was received. See, in all this, the only truth is the bank statement. So, to do an avoidance review, you have to intensely look at your bank statements, much more than you're looking at your SAP or your Oracle or your Tally data. Round tripping of loans received, diverted to other group companies. Loans taken without NOC from existing lenders. Unsecured loan becomes a secured loan without new value getting created. Loans stated as received in cash and admitted by the RP but not properly reflected in the books of accounts or charge created. This is an aspect I've been hazy on myself. Let's say you have a corporate debtor who's never updated his financials in the last 4 years. So I've also filed, let's say, a 19-2 application saying that books and records have not been provided to me. And there's a creditor who comes and says, I gave a 50 lakh loan in cash. Corporate debtor also said, yes, I've got the cash. Do you admit such a claim? I would think not. I would keep it in abeyance because my very books and records are missing. And to add to it, if you have an accounting system like Tally where you can pass any entry at any point in time, there's really no sanctity to such claim admission process. I'm not really sure how the tribunals have looked at it, but I think this is something that needs to evolve. And I'm not getting into aspects such as 269 SSTT, etc. I don't want to confuse statutory compliances with claim admissions. Although in my opinion, they should be read together, but I don't think the general view is flowing in that direction. Now, one very interesting thing about Section 43 is it's a very good section because somewhere along the line, the law also realizes possibilities of collusive transactions. And I'm using the term collusive in a very specific context. That might not have been the intent of the section though, but it serves a very good purpose there. So let's assume I'm a corporate debtor and I have an unsecured property, a property which is free of encumbrance. I know that there is a secured creditor, there's another financial institution which is, close on my heels and they're trying to take me to IBC, let's say, or whatever. So what I could do is, I could go to an arbitration and I can even create a loan in somebody's favor and secure the property in their favor. And you would follow a whole logical legal path. I could, go to an arbitrator, a sole arbitrator gets appointed. I have both parties filing applications before the arbitrator making their submissions. And the property charge gets created. Which is why when it speaks in 43, the section says a preference is a preference, provided one creditor has been preferred over another and there is an antecedent debt. It is not in the ordinary course of business, and such security interest has been created by an order of a court or a tribunal. So even if I have a court order because of which I have created a security interest, if it's not in the ordinary course of business, then it is deemed as preference. And it's specifically, so which means as an RP, all litigation you should examine very closely. All payments to lawyers, all arbitrator payments. Now, what does the arbitrator do? I mean, he assumes that the both parties are against each other. And if both parties agree, yes, there was an unregistered loan agreement, then the arbitration proceeds on that basis. So this is just to, sort of point out 43. Similarly, in 50, it's an extortionate transaction. So the law also recognizes that, as an organization tends to approach insolvency, the weakness of a promoter will cause an extortionate transaction to happen. I have a supplier, a good supplier who says, unless you pay me 1 crore, I'm not going to, supply tomorrow. And my whole plant is coming to a standstill. So I go to a private financier who says, okay, I'll give you 2 crores, but I'll deduct 1 crore as interest. So those kind of extortionate transactions elsewhere. In the US, so another very interesting thing is ordinary course of business is ordinary course of business for the corporate debtor. It's not ordinary course of business for the other party. Similarly, in extortionate, while we don't have too much of descriptions and definitions in the code or the regulations, the US law says, very interestingly, that that person with whom I've entered into an extortionate transaction is habitually one of those people who does extortionate transactions. So those things again are yet to evolve in our country, but I'm sure they'll come in. Certain loans settled in priority over other loans. Loans received at exorbitant rates of interest become extortionate. Stated as a secured loan by an unregistered memorandum of deposit of title deeds. And antedated transactions. Loans recognized due to invocation of bank guarantees. See, there is a BG which is, been invoked. That BG itself does not reflect a genuine business transaction. So what happens to that loan? Again, it's a bit delicate because your BG would have been provided by a bank. And if the substratum is fraudulent, and these are things I'm slightly leaving open-ended because they're things where you need to apply some thought process. And again, I think the financial creditors are equally responsible in terms of, the times they have given loans and managed. Security interests and claims recognized based on the basis of an award by a court or a tribunal. Sudden conversion of unsecured loans to secured loans, impacting your 53 ranking. So these are important. Similarly, I've gone through unsecured loans, some common scenarios which would be the same thing. So how do avoidance transactions occur in various segments? Purchases and current liabilities. My current liability itself could be fictitious. I may have never purchased anything, but I just want to bring him in as an operational creditor. Another very interesting thing is in a lot of project companies, sometimes the debtor, pays the creditor directly. I've seen this in government contracts especially. The government says, look, I don't trust you anymore, so we'll start an escrow account. I will make the payment for the project which you are delivering for me directly to the creditor. But today, my corporate debtor has not adjusted the debtor and the creditor. My balances are overstated. These kind of transactions you'll have to examine. Fixed assets. Your assets are being used by other entities. Sale and leaseback transactions. Unauthorized creation of security interests, for example, your JAL judgment. Assets used for personal purposes, costs borne by company. Undervalued sale of assets without an valuation report. So in this context, the law is very clear on undervalued transactions. There are only two kinds of undervalued transactions. One is a gift. Two is where I've received lesser value. In a gift, I received no value. So I gave away, let's say 50 lakhs to a director's daughter for her marriage. That's an undervalued transaction. Two, a property worth 10 crores, I sold it to the director's brother-in-law for 5 crores. That's an undervalued transaction. Special purpose vehicles, business divisions. Incorporation of SPVs and transfer of funds to such entities. The Indian SPV is subject to strike off and loss of trail of funds. Interestingly, the MCA has struck off some 6 lakh companies. So please go through your corporate data to find out if they've transacted with any of those entities, both as debtors and creditors. Existence of foreign SPVs, which have suddenly got closed. No notice to lenders, no trace of funds moved, no trace of utilization. Creation of assets abroad, creation of assets in related entities. What I told you was an example of a loan paid to a related entity, from there on, don't know. Sale transfer of business divisions or segments, which are key revenue earners. So as an organization is tending to approach insolvency, I sell off one business division. That's it. I had a company which was into, let's say, chemicals. I also had a software company, software division. Suddenly that software division, I transfer it out. So my financial creditor gets impaired. Investments. Be very careful. You invest in companies which don't even exist. Your corporate debtor shows an investment. There's a partnership firm. There's a proprietorship. There's a company. You have to examine whether the investment went. If today I am investing somewhere, there has to be some business decision, there has to be an agreement, there has to be an approval under whatever was my erstwhile law, your current 186 or the 180. So similarly, I receive money from my banker and I go and invest in a subsidiary or in any group company, related, unrelated, exorbitant share premium. Why would I do that? That's a diversion. Again, do I have an agreement? No. See, sometimes you invest at an exorbitant premium because there could be a business decision, but that's fine. But if it's not, then it becomes an avoidance transaction. No return on investment. In several companies, you will find that somebody has invested money in some company and then it's lost. Nobody knows. No return on investment in terms of dividends, refund of capital even after a long period of time. I have not sold the investment. I have no bankability. So today, when you are appointing a registered valuer to do the valuation of investments, it's equally important to understand what was the business rationale behind that investment. Large investments extinguished or written off and recorded as losses. So that's a very strong indicator. You just keep on making provision and diminution. See, again, you should not confuse a good, clean statutory audit report with everything is hunky-dory with the business. See, today, as long as I've provided for a diminution in the investment, my statutory auditor is happy. He'll say, okay, fine, you made a provision. So my assets are stated at true and fair value. No, but as an RP, you go one level further. Why did you invest? Where did my money go? Today, if there is a certain fund infusion from a creditor, which was not rightly deployed, that could have cost the insolvency. And shareholding diluted by fraudulent or collusive rights issues. So when you're going to do something on your investment, to review an investment transaction, please look at it in toto. They may not have even issued a notice of rights to you. Please go into that balance sheet and see whether there is a change in that share capital. You have to just give me a minute. Sorry, it was somebody who never calls who kept calling urgently. Yeah. Am I audible? Rita, am I audible? Am I audible? Rita?
Yes, ma'am.
Okay. Yeah, thanks. So, inventories. Similarly, on inventories, I could have avoidance transactions. A large amount of inventories got disposed of. Today, I saw floating on my phone a certain complaint made by somebody against an RP, against some, inflated purchase transactions or something like that. So, whatever it is, this is not conduct as an RP, but inventories can also be subjected. You might have inflated stock in book debts reporting. You can have evergreening of operational creditors by defective return processes. See, today an operational creditor I pay an operational creditor by evergreening him. So I have an old creditor, I book a debit note and then I create another credit note so he becomes new, and then somebody says, no, this is in the ordinary course of business. Undervalued or alienation, sale of inventories, not through the designated bank accounts. In fact, in this particular comment which is circulating in the net today, it said something like, the promoters sold off inventory for cash and the RP did not notice it or something like that. Sometimes your corporate debtor says, I have no record of inventory. That's a great case to do an avoidance review. Receivables, inflated receivables, large receivables getting extinguished or written off. See, as an RP, you need to write to each of your debtors and make sure that the money was not received through some other bank account. and to find out whether it is properly receivable or not before you write it off. Customer payments are made directly. This is what I told you, where a debtor is credited, paid a creditor directly. So these are examples across the system. Now I'd like to stop here and just maybe walk you through, one or two examples. Okay, this is a simple example. A CD has 100 crores of inventory in their books in 2010. CD also has debts of 400 crores to various banks. This inventory of the CD is transferred to the holding company through sale invoices on credit and no interest is charged. So it's not on arm's length basis. The holding company executes some contracts and receives the revenue, and no part of the revenue is given to the subsidiary. The subsidiary goes into CIRP. The financial statements for the last 8 years states that the receivables are good and recoverable. BG is invoked due to the non-performance of contract by the parent. Parent also goes into CIRP. So what would you do as the RP? You have to file an avoidance application on the parent company for an undervalued and a fraudulent transaction. The undervalued will not come because it's gone beyond that time period, right? The non-charging of interest is an undervalued transaction, while paying 100 crores without any consideration is a fraudulent transaction. But if you go on a very hyper-technical mode, for the last 2 years alone, you can take the 18% and show it under Section 45 saying that I have not collected my interest during this period. Broadly, see, the tribunals may not get into that level of detail, but this is a classic transaction which can be reported as an avoidance, which should be reported as an avoidance transaction. So this is just an example. I'll anyway leave this presentation so you can go through some of this later on as well. Now I take you to the red flags note. Rita, is it visible?
Yes, ma'am. The PPT.
Yeah. So the entire objective of this note, and I must compliment the board for bringing it out in record time. I'm sure most of you who are there, many of you who are in this webinar would have attended the roundtables. So there was some kind of an initial process.
Ma'am, the gray screen only is coming. The document is.
Okay.
Maybe you can again start opening it.
Yeah. Is it clear now? Rita, you're able to see the screen?
Yes, now able to see the screen. Yeah.
So this was the facilitation note that IBBI had issued, and I must compliment them because they held 3 roundtables back to back. And the whole thing, I think, was completed within a month. And the kind of support that you could feel across the ecosystem from a regulator was phenomenal. They were very, very committed, and I only wish we do more. And very fundamentally, and Dr. Saini, who did the forward today, was also an integral part of this exercise, along with other senior officials of IBBI. And the amount of senior presence was very, very impressive. And I thought that's very good from a regulator. I mean, the highest possible levels, EDs, and I think even the chairman, sir, was there in these presentations. So very simply, you need to obtain books, records, information, inquiry. You need to look for red flag indicators which point to the need for avoidance reviews. Then you do the review, and then you file applications before adjudicating authorities for value maximization. So this note basically talks about this segment, the second quadrant, which I'm pointing out to, which is the look for quadrant. So this was issued in August. And another interesting thing is, this document, I think, is as much relevant to the statutory auditor of a company if any of you is doing a statutory audit, please go through this note in the context of such statutory audits. It's very relevant because you today as a statutory auditor, you're supposed to do 143.12. You're supposed to do your 143.1 inquiries. The whole perception of the market of a statutory auditor has changed. So it might augur very well for us to run through this to see if any of these indicators exist. So they held these roundtables. Just look at it: 22, 27, 20, 31, done. And then this note was actually issued on the 7th of August, which I thought was remarkable pace. For the convenience of the IPs, the various red flags have been collated and placed under 6 broad categories: entity, group and operations, maintenance of books and records, regulatory compliance and litigation, independent auditor reports, financial statements and board reports, and classification and reporting of frauds as per the RBI master directions. So what we've basically done is to run through each of these chapters to have some bullet points on what one needs to look for. So what's again very important is I find one aspect of this note being covered in my corporate debtor. So that's not a great reason why you should do an avoidance review. But if you have a combination of elements that touch on this avoidance note, which are pervasive, I won't even use the term so pervasive, which are reasonably pervasive, then please don't take a chance, do an avoidance review. So entity, and I think this, and if you look at it, I think it's all very clear. Today, you can't, first of all, as an RP, you can appoint somebody, but the responsibility still rests with you on whether they have done a thorough job. Secondly, I have been appointed by somebody to do this forensic review. I have an equal responsibility to ensure that I deliver a great report. So for me also, if I'm doing an avoidance review, this becomes important. Entity and operations. Certain sectors could be more prone. I'm not going to do a verbatim read, but I'll just tell you what's in the clause. Certain sectors could be more prone to avoidance transactions. Material changes such as acquisition, sale of a division, brands being acquired, sales, intangibles, fixed assets is important. You gain a thorough understanding of the last 8 years' balance sheet and look for unusual items like large write-offs, large provisions for obsolescence, prior period items, large guarantees, huge litigation. Any entity marked by a complex transaction structure or an unusual structure, 80% of my purchases is from a group company, 80% of my sales is to a group company, high level of imports, exports is a red flag, predominance of cash transactions or a sector where there is cash. Check whether the registered office of the company where you're sitting and trying to do work is the same as the MCA registered office. Presence of the large number of, whether you have any foreign presence is a red flag because money could have gone outside the country. Any FEMA non-compliances. You also need to check whether, you have a 200 crore company, debt company. You don't even have a CFO. Is it possible to run the company? Now, when you don't have a good management in place, somebody will say, okay, just pass a journal entry. Somebody could have passed a journal entry and paid somebody. So there is a larger scope for a management override of control when your internal controls in the form of a good finance or a management team is lacking. Directors being disqualified under section 164(2) for non-filing of financial statements. Not only my company, for which I am the RP, but any other company also. Frequent changes in directors, KMPs, and even auditors is a red flag. Independence and competence of directors. You go to these companies to whom your company is given money. You go and inquire who is the director. You may not even be able to locate the director. You've had these issues of namesake directors, right? Statutory auditors. See, this is again a clean audit report does not mean everything is fine. Again, your CD is part of a large group of 100 entities. Can I have a very small statutory auditor who's not very large? I mean, that's something that needs to be examined. I'm not for once saying that a sole proprietor can't do a great job. But I'm only saying a sole proprietor with a small office managing a listed company and 10 of its subsidiaries, is important for the RP to review. Presence of a large number of related connected entities. 15. Quantum of RPTs. 16. Government connected entities to whom we have given money and they have not repaid us. Adverse public domain information. whether they are a willful defaulter. One thing that we didn't put in here is, there's also one floating list of some 16,000 shell companies, which is there in the public domain. You may want to go through that. Whether any of the entities with whom you have transacted form part of that. Earlier forensic reports. See, I think some of this has to come out very clearly in your COC meeting. You have to make a formal request for an earlier forensic report. And I think as an RP, it's pretty much your entitlement to get that report. Inadequate data, non-circulation of reports. So if somebody says, I've done a forensic and nothing came out of it, don't take it at face value. That forensic will have 6 pages of disclaimer saying that I did not get any information, so I'm unable to conclude. Please go through. See, and in my opinion, you're as much accountable to the last stakeholder, last imaginary stakeholder in 53, as you're accountable to your secured financial creditor. Because that the money that you bring in through an avoidance process could even result in your, imaginary shareholder becoming real. Somebody might say, no, there is no asset, so where is my shareholder? So please remember, you're doing a fiduciary relationship for the last person on the value chain also. You have operational creditors, you have employees, workmen. So that's the importance. In certain cases, forensic audit reports may not have been conclusive due to non-submission of data. That's a red flag. So you say, I want to do this ab initio. See, and that's what Dr. Saini said, right? You put it before the COC and say, look, I want to do it. Let the COC categorically say, no, you will not proceed. And then, we'll have to go through. However, if you find very compelling circumstances, I think you should escalate. Because tomorrow, people are still going to come back to you and say, look, you're the fiduciary, why didn't you challenge? So you can go through the grievance regulations, whether, you can file a grievance, but those kind of processes make it adversarial. But one thing I've largely found is the COCs respect decisions of the RP, especially when they are backed by data. No COC will say, no, I don't want to do. Unlikely. The costs are a completely different issue altogether. Bank guarantee invocation, non-confirmation of balances of debtors and creditors, mail bounces, high-value receipts and payments transactions. Claim versus value of asset is also very interesting. None of my creditors are filing claims. Why would that be? Right? Unless a debtor has paid off a creditor, directly, or there has been a siphoning. Non-maintenance of books of accounts. Non-maintenance of secretarial records. RP comes and then they say, no, we lost it in flood, fire, etc. Basic registers such as inventory register, fixed assets registers not maintained. Accounting system internal controls not great. No audit logs. Secretarial audit conducted. If mandatory, any issues. If it's not mandated, our basic compliance is met. Cost audit issues. Internal audit issues. Tax audit issues. Non-registration with GST. Your company pays money to somebody as a loans and advance for some purpose. That company doesn't even have a VAT or a service tax or a GST registration. Cases filed by regulatory authorities such as RBI, FEMA, SEBI, SFIO, police. High value of legal and professional fees consistently paid by the entity. Litigations in various judicial and quasi-judicial forums. All arbitrations, sole arbitration, panel, etc., needs to be reviewed. Now, audited financial statements and independent auditor reports. Take last 8 years reports, go through the audit report, go through CARO, go through ICOFER, find out if there are any unusual material items in the notes also. Balance sheet, P&L, cash flow, notes on account, independent auditor report. So actually you can convert this into a checklist. So you say, okay, balance sheet, I finished reviewing. 1, 2, 3, 4, 5, 6, I have an issue. P&L, 1, 2, 3, 4, 5, 6, I have an issue. Non-filing of audited financial statements. Why would somebody not file an audited financial statement? You can be under tremendous financial stress, but that does not stop you from doing an audit and filing a statement, right? Another interesting thing you come across is the CFS is not prepared. You can have two circumstances there. The auditor says, I have consolidated unaudited statement. The second thing is the auditor says even the financial statement of such subsidiaries joint venture is not available, especially if it's a foreign subsidiary. Right? Clean audit reports will not obviate the need for an avoidance review, as audits are prepared and performed for a specific purpose under a framework. See, I am an auditor, I audit by ASSA, that's it. I am not going to go into propriety, preference, all that. Significant qualifications in audit reports, however, are a definitive red flag. Because a lot of times a qualification will describe, 30% of the issue. The 70% when you dig deep, you will find out. Some illustrations of qualification could be non-compliance with accounting standards, no fixed asset register, investments in other entities, high value inventory. Consistently they keep saying inventory not verified by the auditor, certified by the management. Violations of 73, 74, 185, 186, non-recoverability of advances, confirmation of balances not receivable. See, 80% of my receivable is from a group company. Then how can I not get a confirmation of balance? One does not understand. So read a little more into it. Interest-free transactions undertaken by the CD. Reports on fictitious transactions, which are as mere book entries. High value of disputed and undisputed statutory dues is a red flag. The next chapter is on financial statements and board report. A bulk of it I've actually covered in the earlier part of my presentation. Non-preparation, non-filing, unsigned financial statements to MCA. I've seen a couple of cases where they just file something. It's not even signed by the director. Incomplete board reports, repeat qualifications by auditors, fixed assets and CWIP. You can go through these in some detail. I would like to, sort of wind up. Not because of anything else, just leave some time for questions. You have red flags relating to fixed assets and CWIP, significant revaluation reserves, sale and leaseback transactions, large sales of assets without valuation reports or a competitive sales process being followed, SPVs and investment in vehicles, transfer without underlying business purpose, creation of assets abroad in such SPVs, exorbitant, unjustified share premiums, no return on investment in terms of dividend or refund of capital, large value of investment, but it just says provision for diminution. What's the charm? After all, I put my banker's money and bought that investment. How can one be not accountable and just write it off? Shareholding diluted by fraudulent rights issues, which we spoke about. Inventory not handed over to the RP. That itself is a red flag. How can somebody say, no, I don't know, it's there in my project site? Inventory registers not maintained. No proper internal control. No physical verification protocol. Variances not examined. Sale of inventory other than in the normal course of business. Revenues and receivables. We'll skip this. Sudden increase in unbilled revenue. See, though, that could be a fraudulent financial reporting. Receivables written off based on arbitral awards. Audit qualifications and revenue recognition. Bank transaction. If my corporate address had some 30 bank accounts, then I'm actually concerned. They will just keep moving funds from one account to another account to keep the cash credit live. Diversion of funds, round tripping of funds, fund movements not through designated consortium accounts. Loans and advances, same thing, given without agreements on an interest-free basis. It's given to entities which are sitting in strike off. What will you do? Share capital, we covered it. Loans, we covered it there. Payable accounts. So these are some of the red flags. But primarily your good indicator is to take your biggest bank statement, top 3 bank statements, and you review. You'd be able to identify whether there are avoidance transactions. Now, a lot of times you get a question. See, I've not even got books and records. How do I do an avoidance review? You only get the names of the bank accounts of the company and you can start from there, get the bank account statements directly and start your avoidance review. The last one is, of course, a very generic kind of checklist. The RBI had given some 42 categories of RBI master directions. They had said these are 42 early warning signals. So these are more or less, we've covered it there also. But if now this is something that the bank would have looked for in their forensic reports. So you must take into cognizance those reports as well in identifying your red flags. And that's about it in terms of my presentation. And the bottom line is the process that you normally adopt should be very linear. You decide whether you want to do a forensic audit in terms of a preliminary determination. You can discuss your preliminary determination with the COC and report to the board. The COC then, approves the engagement of a forensic auditor because that's where you're going to get paid from. Then you appoint the forensic auditor formally. You give a notice to the promoters, directors, or the promoters stroke promoter directors or directors. And those in the, what you call is those who are charged with governance, those people. And tell them I have set up a forensic audit. They will be corresponding with you. Encourage the auditors to be in touch with them also. See, you'll need to, everywhere I would trust, but I would also verify. And before you appoint such an auditor, you must have a wind of how this thing will come up. So ensure that you are marked on every single communication. There's an evidence building process. So the forensic auditor comes across one transaction of payment to a group company which has not been refunded. The forensic auditor is expected to write a mail on that particular transaction, get a response, satisfied, not satisfied, then takes it to the report. And the forensic auditor's final report should ideally explain the circumstances of the audit, that he has been appointed, etc. And then go to each transaction separately. Ask them to give each transaction as an annexure or each respondent as an annexure, so that you can then take that annexure and prepare your forensic application. It just makes the process a lot more simpler. And then during the course of NCLT hearings, you must remember one thing. After all, it's your name. So you must stand by that application. And today, don't do anything sort of half-baked. If you're preferring an application, it must be to the best of your knowledge and ability that it is indeed an avoidance application. And it's also very important that your forensic audit reports don't look like internal audit reports. It just ambles on and doesn't conclude, doesn't help. It should say this is an avoidance transaction. This comes under 43, 45, 49, 50, 66 or a combination of sections. This is the amount that needs to be plowed back. If this clarity is not there, then it will be very difficult for you to prefer an application. So that's about it. And with these few words, once again, I'd like to thank the IPA for this very, very nice opportunity. And in all this, I must admit that I'm the biggest learner, because every time I do a session, I go back and read something a little more. And it's been truly beneficial to me. And I hope you enjoyed this session as much as I enjoyed presenting it.
Can we start taking the questions, ma'am?
Yeah, I'm seeing my chat, but I can't see any.
Okay, in the email box we have sent to you.
Oh, okay. What if financials are not available for the relevant period? How to examine PUF transactions? Get the bank statement. That's the best you can do. You can get a list of all the bank accounts and get the bank statements for the last 5-6 years also. COC approved fees for the transaction auditor, but has declined approved fees of the lawyer to file an MA. That's really not possible. In which case, maybe they are expecting you to do this party in person. But normally it's not done, so you could check out with your COC. This seems to be a very unique case. But typically what you do is you also intimate the COC that you need a legal counsel. And you also need to explain to them that as an RP, if you go to NCLT, you spend the whole day there because you're waiting for the hearings. So, but that seems to be a very individual case. But you need to get COC approval for a legal counsel separately. How can I follow my claim with IP? Is there a time limit for IP to inform claimant regarding the status of my claim? I don't think this is relating to the avoidance process. But in terms of claim, yes, the RP has to ascertain the claim within a certain time limit. I think it's 7 days or something that he has to revert back. There is a time limit prescribed under the code. So yeah, you can write to him. If he's not responding, please keep writing to him. Ask him whether it's admitted or not admitted. If it's a large claim and you're not getting any response, you can, as a claimant, file a case in the NCLT under section 65 for non-admission of your claim. Can a firm proprietor continue his business during continuation of proceedings? I don't know. Are you talking about individual insolvency proceedings? Then it will have to operate as per the code. Yes, but normally whatever is the due process will be followed. What are the circumstances under which we can extend CIRP by 330 days? This is, it's something like this. Today, there is a well-established position in law on something called as an extension, which is that 90 days which you get once. But in a lot of cases, you find that something is pending with the adjudicating authority. So in one case, the very constitution of the COC was challenged. So it went to NCLT, it went to NCLAT and came back, and it took 200 days. So the RP can file something called as an exclusion of time. So this is purely, I'm sure there are CIRPs which are extending beyond 330 days, and such exclusions would have to be approved by NCLT for valid reasons. Videos, I don't know. We'll have to take this with Rita. Financial creditor has provided education loan to son of the director of CD by extension of mortgage or fixed assets of the CD. Yeah, this is not a right transaction. This mortgage is not correct because the assets of the CD cannot be pledged for the personal purpose of a director. So this security interest can be, sort of revoked. In case you have, if it's during that relevant period or whatever. In case you have identified such transactions and are convinced that they are done with malified intent, but COC is not ready to take up the matter or does not take up the matter in COC meeting or has kept it undecided for an unreasonable time, should we seek directions from NCLT or let the matter go as the COC is the main decision maker? If you're honestly asking me, you have to report the avoidance transactions to IBBI. Maybe you should also write to IBBI saying that I have done this determination. I have let you know that I have done this determination. I have placed the matter before COC and it's pending or it's not decided. But if the transaction value is very, very material, then I think you should go ahead and prefer a 65C, asking for NCLT to decide on the matter. And you may mark your COC as a respondent. Again, in the COC, there are two aspects. One is whether a majority COC member or unanimously the COC decides not to have a transaction audit. If some part of the COC agrees with the transaction audit, then it strengthens the hands of the RP. What is the difference between transaction and forensic audit? So transaction normally, both these terminologies are not greatly defined. A forensic audit is any audit that you perform to provide evidence in a court of law is called as a forensic audit. So in that sense, every transaction audit is also a forensic audit because you're doing this audit to determine whether there is an avoidance transaction for which you will have to provide evidence in your court of law. So that's my understanding of how the Google and everywhere define a forensic audit. But for our purposes, what is normally understood is you do a transaction audit for the last 2 years. And for determination of preference, undervalued and extortionate, and you do forensic if there is a fraud involved. So the term forensic is usually interchangeably used with a section 66 fraud audit. What is the responsibility of a transaction auditor vis-a-vis a resolution professional? He has to be true and correct. And the transaction auditor actually has a very large fiduciary role here. If I was an RP, I would trust and verify. The transaction auditor should again be uncompromisable and should report everything. What's the role of the COC for approval of a transaction audit? Well, they need to approve. But again, it's your capability as an RP. If you're able to demonstrate to the COC that there is a value loss and there's a potential gain because of this transaction audit, then they are, sort of bound to agree. Can a resolution professional himself conduct the transaction audit? Yes. There is really no stipulation that says you have to appoint somebody. But how much will you do as an RP? See, if it's 1 or 2 transactions, you can do. But if it's a large amount of transaction base, better not get somebody to do it. And especially if you're going on aspects such as fraud, etc., it's better to have an independent audit report. How can you access the PPT? We will send it to you.
So I think, Shripya, this was pretty interesting. I just had a quick question for you. Like I said when we started, this seems to be pretty tricky in terms of your entire position being an IP. Preserving value, running the company that you would run as a CEO, making sure that all the ethical aspects are also on top of our mind. Sometimes all of these don't gel very well. Yeah. So from your experience, how do you keep the right lines right? Any suggestions that you have for that?
So, see, these are separate tracks. Your
Correct.
paramount track is to find a resolution plan. So if I'm an
Correct.
RP, that's what I'd start with. I'd go find somebody who will take over this asset and run it as a going concern. 2 is all the others that come with it. I need to update my financials, keep it as a going concern, find interim finance, which is quite difficult actually. The third track is this avoidance. So if I have these really small non-material amounts, you place it before the COC and let go. But the transactions that we're talking about here are so large and so material. Then you take up. And typically, who are the respondents? The respondents would be the promoter directors or those who are running the company.
So that also takes away, Shilpi, a lot of time and energy when you start focusing on these transactions because they need you to deep dive, understand it appropriately, whether business decisions were driving those transactions or whether non-business decisions were driving those transactions. So it's not always like a black and white. So any experience around that?
Which is why you hire an expert.
Okay.
Today, very clearly, as an RP, I will go through my financials for 5 days. And what do? I plot out last 8 years balance sheet, quickly go through the tally or SAP, look for broadly. I'll know whether it's a business failure, a financial failure, or a malfeasance. And as an RP, I have to do that. The moment I find that there is a third category and there's a lot of fund movement across entities or whatever, large transactions, then I engage somebody to do a transaction audit or a forensic audit. And then I engage my legal counsel to file the applications and fight them in the court because you don't have that kind of a bandwidth, even if you have a large office, because ultimately it's your head and your name on the block. So you need to get support, most certainly.
No, fantastic. So I think I've always got excited that this actually puts chartered accountants in almost like a CEO kind of a role with a lot of burden on his shoulder to ensure high ethical standards as well. So this is a pretty interesting one that we have. So yeah, Rita madam, do you have any more questions coming up?
Yeah, some more questions are there, sir, if we can take up.
Yeah, please.
Yeah. Can an avoidable transaction petition filed before AA be withdrawn by a subsequent RP who has replaced the earlier RP on the resolution passed by COC to that effect?
If the COC has authorized the withdrawal of that application, then obviously he will withdraw. But again, the second RP who is withdrawing has a huge responsibility. Because if it comes under, 43 is slightly harmless. It says, okay, you have to determine the avoidance transaction and you have to file it with the with the adjudicating authority. Suppose it's a transaction under 45 and you have withdrawn, other creditors can actually file that application then. And third is, today the NCLT is an open process. You have this ameliorative section under section 65. So anybody can approach the tribunal under 65, file a case and say, look, this RP has not done this properly, he has caused this withdrawal. So one needs to be very careful. Today the code is so open that any stakeholder, any person connected to the process can approach NCLT.
Can we go to the next question, ma'am? The question is, can interest-free loan considered as undervalue transaction?
Absolutely undervalued transaction. If my corporate debtor is paying interest to a bank, why would I offer something free of interest to anybody? And it's very well established, right? Nothing. See, and one thing we need to expect in this is the corporate debtor is a distinct legal person. You have to maintain that unique legal identity in any examination. So if my CD has lost value for a non-arm's length transaction, then it's most certainly undervalued. Not only undervalued, if there is no clear objective for that loan to be given to somebody, I would even put it as fraudulent.
Okay. Can preference be seen for same class of creditors? Sometimes it is very difficult to identify the preference of one transaction over the other.
So I'll give you an example. So I know where this person is coming from. See, these are called intercreditor preferences. I have two banks. I paid one bank on time and the other bank I didn't pay on time. So the other bank becomes an NPA. Now the other bank can now charge and say, look, that's a preference. That's not a preference because it's in the ordinary course of business. Now let me give you another example. I took money from a private financier. I had a loan agreement where I was supposed to pay them only in 5 years' time. But 3 months before the insolvency, I paid them. But I did not pay my nationalized bank, who was my other creditor. This can be regarded as a preference because as per the loan agreement, you were only supposed to pay in 3 years, 5 years. This can be a preference clawback. And again, in a preferential transaction, the person from whom I have clawed back comes back into my 53 waterfall. He can give me a claim for that value.
Okay. The next question is, to qualify for section 43, one requirement is antecedent debt. So what if creditor has debit balance and it keeps increasing by giving loan?
It's a fraud.
Okay.
Because the section is very clear, it's for an antecedent debt. So he
Okay.
has to be a creditor for 43. One thing I've noticed is tribunals don't take such hard views in my own cases also. So if he's given, so this is just the reverse. In fact, at least if he was a creditor and I have paid something, it can be a preference. If he's a debtor and I keep paying him, loans and advances, or he's taken money from me and I keep paying him more money, then it's more likely to be 45 and 66. It's undervalued.
Okay. There is this next question. Throw some light on powers of ED, CBI, SFIO vis-a-vis RP in case of countermeasures of attachment by such agencies.
See, the law is very clear. Where there is a moratorium, there is no attachment on the company property. They're quite free to proceed against promoters in whatever ways they want. So in terms of attachment, I think the moratorium provisions are well defined. I think you have to go. Interestingly, there's a debate here. So if during moratorium, let's say somebody has preferred a claim, and let's say an RP has even admitted it erroneously, to set aside that claim, let's say I'm a replacement RP. A particular inspection has happened during moratorium and a claim has been preferred. In fact, I'm not even going to the point of attachment, which is clear. So a claim has been preferred by doing a proceeding during the moratorium. And today, to set it aside, can I go to NCLT or should I go to the High Court is an open issue today. I'm being advised it's to go to the High Court because two tribunals, for example, service tax and NCLT, there could be a challenge. So I've been told you must move a writ. So these are some of these things which are emerging now. But yeah, I think the law authorities, the tax authorities are also getting much more, vigilant these days. In the beginning of CIRP, we hardly used to get any operational creditor claims, but now there is a lot of action.
I think, was it the last question, Rita Madam?
Yeah, I think it is.
Yeah. So I think, Shripriya, this has been a fantastic session. And I think you, like Pramodji said, that, with a lot of clarity and brevity. So I think this was very evident, and I'm sure all our members would have heard the sharp undertones and clarity in what you spoke today. You've been very, very straight, right with the answers. So I think thank you so much for coming over, taking out time and addressing us here today. I know that you have done a lot of work when you were in the council, especially around the IBC areas, and you still continue to do a lot of work around these areas that we were talking to Dr. Saab just before I think we started the session. So personally, myself and Rita Madam, we would look forward to engage with you a lot more and try and see if we can try and create this engaging, content-driven delivery to our members, because I believe that besides the act and besides the knowledge around that, practical experience and insights is so important, especially for this practice. And this is only likely to grow, and complexities are also likely to grow when pre-packs and cross-border comes in. So I would really be happy to have you on board to help us to try and go through this journey with deep insights and knowledge sharing sessions that we would have with our members. So I think, well, I look forward to doing this more often with you. Thank you so much for taking out your time. And once again, we're really grateful. And thank you to our viewers for some good questions that you've asked. Please today stay engaged with us. We are hoping to make this more and more interesting for all of us going forward as well. I think 2021, after we go over this pandemic, I'm not sure when we are, but if and when we are through this, I think we're only going to see more and more engaging and interesting conversations around this topic. So thank you, everybody. And thank you, Rita Madam, for taking us very, very seamlessly through this session as well.
Thank you,
ma'am.
Thanks,
Thank you, sir.
Rita, for all of it, and thanks to
Thank
Mr.
you.
Moon.
Thank you. Bye. Thank you.